Jeffrey Gundlach is the CEO of DoubleLine. He joins us now in a CNBC exclusive. Welcome back. It's good to see you.
It's good to be here, Scott. Congratulations on all the great work you've done over the years. And you must be kind of running out of questions to ask by now after action-packed few days.
Yeah, I'm glad you're the last person. How about that? How about that?
Save the last for last.
Yeah. Let me ask you this. You were with us back in July. You said the biggest case for stocks is that they're cheap to bonds. You said, quote, "I think you're okay holding stocks at these levels." Here we are at record highs. What about these levels? Are you still okay holding stocks, Jeffrey?
A little less okay than I was back in July, simply because the Fed is starting to look seriously at tapering. And there's what I call almost Gundlach's investment constant, which is if you divide the market capitalization of the S&P 500 by the size of the Fed's balance sheet, you almost get a constant. It's remarkable how stable that relationship is. And so with the Fed starting to taper, it's getting a little bit more of a cautionary situation. Also, keep in mind that the Fed reducing its purchases is reducing stimulus from the system. We've had the Fed funds rate at zero for a long, long time with a brief interruption. And the Fed thankfully never went negative, but they did a couple of times go to extreme quantitative easing. And there's a model at the Atlanta Fed that tries to divide what is the kind of quantitative, the stimulative effect of quantitative easing. In other words, if you didn't do quantitative easing, but instead went negative on Fed funds, how negative would you have to go to equate to the amount of stimulus that the quantitative easing provides? And that model shows about a negative 200 basis point Fed funds rate is effectively enforced with the effective quantitative easing that we've been doing. So if we take away the quantitative easing by middle of next year, which is what Jay Powell has been saying, I think, again today, that's equivalent to about a 200 basis point tightening of the Fed funds rate, which is probably going to be difficult for the market to digest.
Even if you still have so much liquidity in the system, I know I keep repeating this metric, but I think it's important. It's the equivalent of QE2 plus. So it's not like the punch bowl is going completely dumped in the sink.
Well, in particular, because there's still very high cash balances as a consequence of the government's money spray of many trillions of dollars, which is responsible for all of our economic. I mean, when the economy rolled over into the abyss in the second quarter of 2020, nominal GDP dropped by about $3.5 trillion. And since then, it's rebounded all the way back up by that amount and a little bit more. But the budget deficit, the national debt, has increased by 25% of GDP, which is $6 trillion. And the trade deficit has increased by a couple percent of GDP. So we've really but for the stimulus and but for imports with consumers' money from the money spray, we really haven't had any economic growth. So we have a really interesting situation regarding, obviously, inflation, where no one talks about temporary anymore. Everybody was surprised how high inflation got. When we talked in July, we were talking about how this inflation rate wasn't going to go away. We believe that it's almost certain that 2021 will end with a 5 handle on the CPI. It's at 5.4, and it's going higher in the next couple of readings, thanks primarily to the price of energy. And we don't think inflation's going below 4% anytime in 2022. And so the other thing that's interesting about inflation is the PPI, which leads the CPI, has risen by more than 0.5 every single month in 2021. So we have the most negative interest rates we've had, really going back to Jimmy Carter days. And it's really an issue. The thing that's transitory, perhaps, about inflation is some of the commodities like lumber has fallen down. But there are two factors waiting in the wings to keep the inflation rate elevated. One is wages. Wages are very interesting. They've exploded on the low end. From the 16 to 24-year-old cohort, wages are just sky high, and they haven't risen for age cohorts above that, interestingly. They've kind of leveled out but are not rising. The real question is, will the low-level wages for first-time workers start to push up supervisory wages? And I think the answer is yes. But more importantly, rent is going to go up, or shelter, I should say, which is 1/3 of the CPI, is going to go up for sure. In fact, the owner's equivalent rent, which is a concoction that goes into the CPI, that's pretty much just a construct and not really a fact. They show it rising over the last 12 months at 2.9%. But the Case-Shiller median home price in the United States is up 20% year over year. And there's some rent data series that are pretty reliable that show that in the last 6 months alone, median rent has risen by 10% plus non-annualized. So it's almost certain that we're going to get persistently high inflation thanks to the shelter component going up, and perhaps wages too. So the negative interest rates we have today are wickedly unattractive, but they do support still, like I said in July, not as much as July because stocks are up and yields are up, but stocks are still not overvalued versus government bonds. So
what's the critical level we should be watching and that you're watching on, let's say, the 10-year?
Well, I think 2% is really the key. We were looking for the 5-year to go up to 125 to 130. And that's really the one we're looking at the most right now is the 5-year. It's been the real mover, and it really factors in what people really think about the intermediate term for the Fed. We were targeting about 125, 130, and I'm not surprised that we started to get some relief off of that. The 10-year up at about 175 is sort of comparable to the 5-year at 125. But I do think that we will take a peek at towards 2% on the 10-year before year end.
So if before you said the right portfolio mix, if you will, and I know our viewers are interested in hearing an update on this if there is one, was 25, 25, 25, and 25. Stocks, gold, long-term bonds, and cash. Have you adjusted that now based on your current view?
Yeah, I adjusted it actually several months ago. I thought we talked about this in July, and that was 25% cash is too high against a 0 interest rate on cash and against a 5.4 CPI. And when I say gold, what I really mean is real assets, which includes commodities broadly and real estate. So right now, I don't think it should be 25% cash. I think it should be down at call it half of that, 12.5%. I like stocks at 25%. I like European stocks. I've switched from U.S. stocks to European stocks several months ago. For the first time in the history of DoubleLine, which is 12 years now, we bought European stocks. And it always feels really weird when you've avoided something and it's been the right thing to do, then all of a sudden you decide to take the plunge. And it really hasn't worked owning European stocks instead of U.S. stocks since then, but it hasn't not worked. They basically have moved up in lockstep, which is really interesting.
Why is now the time? Why is now the right time?
Because the dollar is going to go down, and European stocks are very cheap compared to U.S. stocks, and the European economy is a little bit more oriented towards the economic situation that we're in, I think, than the U.S. consumer-based economy so largely. But the dollar is going to go down. I'm not sure it's going to go down like this week or this month or this quarter, but the biggest factor in the dollar, the highest correlation is the twin deficits. And the budget deficit, of course, has exploded to levels never seen before. It doesn't look like it's going to relax very much, although the spending in Washington, thankfully, is running into a little bit of a headwind. And the trade deficit has increased. When you get the twin deficits increasing, it's very highly correlated to a negative dollar trend. And the dollar has peaked out. It peaked out at 103 on the Dixie index twice. It double topped back in January of 2017 and then back in this cycle as well. So it's down at below 94 now. The real key is if it impulses below 90, then it's time to buy emerging market equities, and the European equities will continue to do well. We haven't owned emerging market equities. They've been very challenged with the COVID situation and the economic situation, but they're very, very cheap. It's just a question of when the dollar starts to go down. That will lead to, especially for dollar-based investors, it'll lead to very outside outperformance. Dr. Shiller's CAPE ratio is elevated on the S&P 500. Under normal circumstances, you'd say it's overvalued, except for the fact that bonds are so overvalued that stocks sort of look cheap. But the emerging market CAPE ratio is less than half that of the United States. And though it might seem that that should be normal because the United States is more reliable, it's actually a fact that historically, over multi-decades, there have been numerous periods when the CAPE ratio of emerging market equities was higher than the CAPE ratio of the S&P 500, which, although overly simplistic, suggests that it's not folly to believe that under the right circumstances, emerging markets can outperform the U.S. by fully 100 percentage points. And over a multi-year time frame, we expect that's going to happen. It's just a real difficult situation of when is this going to improve. Also, so 25% stocks. I also like real assets. I like commodities and real estate more than gold. Gold will be well when the dollar starts dropping also, but commodities are unbelievably strong. But for the fact that they haven't had any correction, I'd be wildly bullish on them. They've gone up 75% since their bottom last year, and it almost doesn't matter what index you look at, especially in industrial materials, everything but interesting gold and silver. So that might, up 75% seems like a lot, but the cycle of commodities is very long. And commodities are still quite cheap on a long-term basis versus, say, the S&P 500. When the worm turns, which it looks like it has on commodities from a very cheap level, historically, it's not foolish to believe commodities could outperform by several hundred percentage points. And that seems to be in prospect potentially. So commodities aren't the greatest trade location right now because they're up so much, but I think I would have about 30% in commodities, maybe even 35% in this mix of real assets, real estate, commodities. And then the long-term bonds do make sense because with all of this seismic shift in government policy and economies that are almost impossible to divine right now with so many plates spinning in the air, you do have to worry with all of this debt about the potential for a debt deflation. I'm not predicting it, but you need those bonds there at 25%. Now that the yield is at 2% or so on the long bond, even above 2%, it is possible to make 30% on long-term bonds as a hedge for your risky assets in a balanced portfolio, because we've seen 30-year treasuries drop to inside of 1% in the COVID nightmare. And of course, 30-year treasury bonds in many, many developed countries are kissing the zero line as we speak.
So let me ask you before we go, lastly, Bitcoin has defied many people's expectations, yours included. I mean, when we were last on, you said the chart looked scary and had lost support. Here we are. We're up 85% since then. How do you view it? How do you view it today?
Well, it's scarier. The chart's scarier today than it was in July because we have a double top at 60,000+ that we basically did a blow off this week, it looks like to me, and now it's reversed back below where the top was. So I really think that a lot of things crescendoed this week. I think the bond yield rise has crescendoed this week. We're probably going to get some relaxation in the near term. Bitcoin, et cetera. Even oil, I think, has done that. So I think we're in a counter trend move in the weeks ahead. So everything that sort of worked for you in the last few weeks, I think it's time to fade.
See how it all shakes out. Jeffrey Gundlach, thank you so much for being a part of our special week. We'll talk to you soon.